Hello, this is Mike Shear with Ag Risk Solutions. I want to take a moment to talk to you today about a couple of options that producers have to increase their yields for crop insurance and increase their coverage that we find are underutilized and are a very good option for producers. So to show you that, I'm going to go through an example today. The example I'm going to use is a Jefferson County, Kansas corn, non-irrigated. We're going to look at 100 acres of corn with enterprise unit coverage and a base price of $3.96, just like it was for 2017. So over here I have an APH yield database that you should be familiar with. Has all the crop years that corn was planted on this farm, and then this column shows the actual yield in each of those years. So if we take those 10 yields and average them together, we get an average or approved yield of 140 bushels per acre. Now the first option I'm going to talk about is the trend adjusted APH. This is designed to account for the fact that our yields are improving over time due to better farming practices and better technology. So this column shows the amount that would get added to each of these actual yields based on how old it is. And that is calculated using a trend adjusted factor for this county of 1.71. So you can see how much it adds to each of those yields. And then this column shows what the new yields would be with that adjustment made. When we average those 10 yields together then, we get an improved yield of 150 bushels per acre after adding the trend adjusted yield option. So the second option I'll talk about is yield exclusion. So for each county and crop, there are certain crop years that are eligible to be excluded. For Jefferson County non-irrigated corn, the 2012 crop year can be excluded. So if we get rid of that and we average the remaining 9 yields, we then would get an approved yield of 159 bushels per acre after adding both of those options. So we've gone from 140 to 159. So that's great. Obviously now we want to know though is how much is that going to cost me and is it worth doing? So we're going to assume in this example that initially you had been carrying 75% coverage with the 140 bushel APH situation. That would give you $416 per acre of coverage and would be costing you $7.10 per acre in premium. Okay, so if we add trend adjustment and yield exclusion and stay at 75%, our new guarantee is going to increase to $472 per acre, and the premium increases to $10.70 per acre. So we gain $56 an acre in coverage, but you're going to pay $3.60 an acre to get that. So is that worth doing? I don't know. What we've found is a lot of producers out there look at that and say, you know, that's about a 50% increase in premium. I'm not sure I want to spend that much on my crop insurance policy. But what gets forgotten is that there are other options once you've added trend adjustment and yield exclusion. So if instead we look at going to 70% with those two yield adjustment options, that would give us $441 of coverage for a premium of $7.20. So now you can see you've picked up $25 an acre in coverage and are only paying 10 cents per acre more in premium. So that's basically the same premium, significant increase in coverage. You can even look at going down further. 65% coverage level would give you $409 per acre of coverage for $5.70 per acre in premium. So about the same coverage that you had before, significantly less premium. What we find in most cases is that people look at doing something like this and picking up that $25 an acre coverage essentially for free. And it's kind of easy to look at that and make light of it as just $25 an acre in coverage. But hey, if you have 1,000 acres of corn, at the end of the year you have a claim, that's $25,000 extra that's in your pocket for essentially no extra premium. So again, these are a couple options that we find are very valuable to producers. If you're not using them, I would encourage you to contact us and we can try to take a look at your policy and see if you have situations like this as well. Thank you for your time.